we need to talk about ESOPs, and I want to talk about ESOPs in a minute. But let's say you have a shareholder that's selling their stock, and they're going to get a lump sum check from the sale of the business. And, I guess there's a bunch of different ways you can go. One is somebody that's retiring, and they're not going to do any more ventures. Another one could take the money, maybe set some aside for retirement and leave some around for ventures. Mm-hmm. How do you go about helping a business owner that liquidates a company process what they should do with the money? I suppose it has a lot to do with age too, right? I mean, if you're 70 when you do it, you're going to do one thing. If you're 45 or 50, it's something else. Different. What are your thoughts on that?
And this is not selling to an ESOP. You're selling to just a...
Yeah, we'll talk about an ESOP in a minute.
So, the universe is wide open. I would suggest first, separate your personal retirement money from money that you may do another venture with. For the personal money, again, you go back to time frame. When, if ever, are you going to draw on that money? If that is, starting immediately, then I'd say you need 3 or 4 years worth of that income produced by a conservative part of the portfolio, a bond into the portfolio. But there's always room, even in later in retirement, because life expectancy is, so long. You have to have equities as part of that picture. So it comes down to try and gauge how much does a portfolio need to produce in income to meet current needs, and how much of it can be set aside for long-term growth to keep up with inflation and life expectancy. So that could be anywhere from 20% bonds to 80% bonds with the.
I see it with entrepreneurs. It seems like some of them are really good at starting a company, growing it, selling it. Mm-hmm. Others are using the company to be the cash cow to help them buy real estate projects. And, we've got clients that have a ton of different real estate buildings, apartments, and they get leases and income off of it. And it's kind of an income generating portfolio form. But there's a lot of people that aren't any good at real estate. It's kind of like you got to either have the skills and the talent for it, or you don't. Yeah. But if you're a business guy that likes to reinvest in companies, do you recommend that they, even though that might be true, that they put some of this stuff in a lockbox and invest it for long-term growth, and not put it at risk in business ventures? Take some off the table, park it over here, and leave it alone.
Right. Those business ventures are a unique kind of risk. I mean, they're a concentrated risk. And especially if you're active in it, then you've got the business risk besides the concentration. Yes, I think you ought to have a diversified financial portfolio, which is the stock and bond allocation for your personal needs. Whatever amount you're comfortable with, and do the math on what it needs to provide when, and if that's an income stream or if that's growth for the next generation, great. You can set it up either way. The money that you might use, for ventures is a whole different deal. And, real estate, direct real estate investment is usually not passive. You're earning part of that return by the management you have to put into that.